Hello, everybody. My name is Lush Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. Before I launch into the week's happenings, I wanted to let everyone know that I had created an investing and personal finance basics course. It's been in the making for several years, starting out as a lunch and learn for my coworkers, and I kept adding to it over the years. It contains various investing and personal finance learnings and gotchas I've learned over the years. The link is in the description, or you can go to CanadianMoneyTalk.ca, find the course in the Education and Resources tab. It is $50 Canadian, but it is over 6 hours of content and includes a 1 hour one-on-one video call with me to talk investing and personal finance. So, this is my thoughts on market happenings for the week ending February 10, 2023. Looking at the market indexes for the week, the TSX, Nasdaq, S&P 500, Dow Jones, and Russell 2000 were down for the week, breaking an upward trend on interest rate and recession worries, along with some poor earnings reports. Gold and oil were both up, breaking a 2-week lower run. Oil storage amounts are at 19-month highs in the US, which has been contributing to the price coming off recently. Starting with Canada, in a speech by Central Bank Governor Tiff Macklem on Tuesday, we got some good news. He said, quote, "In January, we said we expect to pause rate hikes while we assess the impact of what we've done so far. This pause is conditional. It depends on whether the economy develops as we think it will and whether inflation continues to fall. With economic growth slowing to close to zero in the first half of 2023, inflation should drop to around 3% in the middle of the year and reach 2% target in 2024. We've already seen inflation come down for the prices of many goods, but inflation in the services sector will take longer to cool. We'll be watching to see if the way business set their prices continues to reflect an economy that is overheated or if their price setting returns to normal. We're trying to avoid doing too little or too much, and we're ready to act forcefully again if we need to." End quote. So that means the central bank is pausing for the minute and is looking at data to see what is going to happen. Other good news is that Canada created 150,000 jobs instead of the expected 15,000 for January, as reported Friday. This is far better than expected and may be making Tiff Macklem wonder about his pausing of rate hikes. The world has been naively hoping that OPEC would increase production to help ease the global oil price crunch, namely for Western consumers. Not only have they rejected that notion, they have cut production since last October. Add to this, Russia announced a 5% production cut Friday, reducing its oil output by 500,000 barrels per day in March. Just as oil revenue dependent companies will act in their best interest, so will oil revenue dependent countries. On the demand side, this all comes as China has scrapped its zero COVID policy, the IMF has upgraded its global growth forecast, and the US will be replenishing its strategic petroleum reserves, which is a relatively small amount, to be honest. We may expect triple-digit oil prices to return, and higher oil prices would reverse what has been a falling rate of change in overall prices, meaning inflation. The Greater Toronto Area real estate is coming off the slowest month since the start of the pandemic. The Toronto Regional Real Estate Board says 3,100 homes were sold in January, the fewest since April 2020, when the country was locked down. Sales were basically flat compared to the previous month, with 10 fewer homes changing hands. Buyers and sellers have headed for the sidelines during a rapid rise in interest rates. The benchmark price is down 14% from a year ago, but 28% higher than before the pandemic. Vancouver home sales in January also fell 55% compared to a year ago and 21% from January. Interesting bit of trivia is that 42% of Ontario condos are owned by investors. Nanos Research put out a study of consumer sentiment in Canada and found people are 3 times more likely to be negative when it comes to personal finances compared to a year ago as a result of interest rates, rising food costs, and other challenges in this economy. Consumer insolvencies increased from 2021 to 2022 by 11.2%, says the Office of the Superintendent of Bankruptcies. Who knew that somebody like that existed? This is up across the country, but not as high as pre pandemic, interestingly enough. And Bank of Canada is starting to release minutes of their meetings, just like the US Fed. The aim is transparency of the central bank, suggested by the International Monetary Fund. One of the things in the BOC meeting minutes was that the debt levels of Canadians was one of the considerations in the interest rate hikes. We're heavily indebted, and rising rates have an extra risk to Canadians and the economy due to the debt, and rising rates may cause more of a pullback as a result than expected. It's not clear to the bank how the rate hikes affect mortgage holders, however. Turning to the US used car prices keep getting cheaper, especially Teslas. Prices for used Teslas fell significantly in January after the automaker slashed MSRPs on new models. Used electric vehicle sales overall are also picking up in general as a result of lower prices and new tax credits. In the second half of January, used 2020 and 2021 Teslas list prices were down 4.8% compared to the beginning of the month, prior to Tesla's announcement of price cuts, according to a new report from iSeeCars.com, a car research company. The drop extends a downward trend in used Tesla prices that began in the fall. Lower gas prices have made purchasing an electric vehicle somewhat less compelling, and high auto loan interest rates for used car purchases have brought used prices down across the board. Used Tesla Model 3 prices fell 16.8% from September and December, and then dropped another 5.2% after the price cuts, according to the report. Price cuts on new cars like the ones recently announced from Tesla and Ford on EVs are considered rare in the auto industry, but it's not surprising that used EV prices have fallen in tandem. Naturally, car shoppers judge how much they're willing to pay for a used car based on what it would cost to buy a new one. On the issue of economic slowdown and lower US earnings, there is clearly a slowdown underway in profit growth. Through last Thursday, with 70% of the S&P 500 market cap reporting, S&P 500 fourth quarter operating earnings per share are on track to fall by 11% year over year. A large percentage of companies are beating the expectations, however, because expectations have come down. But the earnings are beating only by a couple of percentage points. I expect this to be indicative of the year ahead, even if the US economy narrowly avoids outright recession. Companies are facing higher interest costs, increased wages, and still high US dollar, declining demand growth, and for roughly 150 large companies, increased taxes due to provisions in the Inflation Reduction Act. After a tough 2023, earnings could stabilize and resume growth in 2024. However, the hit to earnings will likely induce some further corporate caution in hiring and capital spending decisions, adding some drag to the economy. In January, the average hourly earnings of all workers were up 4.4% year over year in the US in a month when we estimate CPI inflation was 6.3% year over year. This will mark the 22nd consecutive month in which wage growth has failed to keep pace with consumer inflation, despite the very high wage growth. Real wages continue to stagnate or even come down, as they have for decades. The US Fed rate hikes are still looking like they will continue at a much reduced rate. Another 0.25% hike is expected in March and another in May. The US Fed has not been saying that they will pause the way the Canadian Central Bank did. The Fed chair rolled out the word, quote, disinflationary, end quote, during his remarks on Tuesday, as he acknowledged that price increases were starting to cool off. But his speech wasn't so dovish. Knowing full well that markets were his primary audience, Powell said it's going to take some time before things normalize, and that the Fed could keep raising rates if the data doesn't show continued disinflationary trends. Quote, "These are very early stages," end quote, he said. Disney's new/old CEO didn't take long to put his stamp back on the company after he returned late last year following a relatively brief absence. During the company's earnings call Wednesday, Iger unveiled a new corporate structure that makes ESPN its own unit, $5.5 billion in planned cost cuts, and 7,000 layoffs. Disney had already been a top performer in the Dow since Iger's return in November, and the announcement was just what Wall Street was looking for as shares rose in off-hours trading. Even Nelson Peltz Trian, the activist firm embroiled in a proxy fight with Disney's board, was impressed. Quote, "We are pleased that Disney is listening," end quote, Trian told CNBC. Now for some bits and pieces. The International Energy Agency released a new report on renewable energy, which says the global energy crisis is driving a sharp acceleration in installation of renewable power, with total capacity growth worldwide set to almost double in the next 5 years, overtaking coal as the largest source of electricity generation along the way and helping keep alive the possibility of limiting global warming to 1.5 degrees Celsius. Energy security concerns caused by Russia's invasion of the Ukraine have motivated countries to increasingly turn to renewables such as solar and wind to reduce reliance on imported fossil fuels, whose prices have spiked dramatically. Global renewable power capacity is now expected to grow by 2,400 gigawatts over the 2022 to 2027 period, an amount equal to the entire power capacity of China today, according to Renewables 2022, the latest edition of the IEA's annual report on the sector. The share of people who think the stock market will fall in the first half of the year is at the highest level ever recorded in a Gallup poll. Gallup interviewed more than 1,000 US adults between January 2nd and January 22nd to gauge their perception on where the economy is heading in the first half of the year. A record-setting 48% of Americans told Gallup that over the next 6 months, the stock market will go down. 18% said stocks will remain the same, while 31% said they will go up. The pessimism isn't contained to stocks. In Gallup's survey, 67% of respondents said that inflation will go up over the same time period. Many respondents were also worried about rising interest rates and the possibility of a worsening job market. The International Monetary Fund has done a study about internationalization and globalization. The free flow of people, goods, and services and capital across borders leads to greater economic integration. But globalization, the trend towards these things moving ever more freely between nations, has plateaued in recent years. IMF's latest chart of the week presents a visual history of trade openness. I thought it was only during the Trump era that the international trade slowed and was finished off by COVID, but the roots came in earlier than Trump, actually around 2008. The energy transition to renewables has also started driving the metal demand. Significant increases in copper, aluminum, nickel, cobalt, and lithium between now and 2040 are the result of the transition. Another interesting statistic is that Canada is 150th in the world for mobile data plan cost, where 1 gigabyte of cell data is $12.55 US. India is the winner at 9 cents per gigabyte. Lastly, an interesting statistic on how long bear markets in the S&P 500 take and how much they drop. The percent decline shows how far the market went from peak to trough, and then the next three columns show respectively, one, how long it took to drop to the bottom, second, how long it took to go from the bottom back to the previous top, and the third column shows how long the drop and return took. Our recent peak was in September 2022, So we are 17 months into the bear market, definitely above average. Turning to China, the MSCI China index fell almost 5% last week, the first fall after a 5-week rally. But the business survey and consumption data pointing to an economic rebound in China, I expect the market to regain momentum. I am bullish on emerging market equities and have been for years, apparently ahead of my time. After more than 2 years of strict rules to prevent the spread of COVID-19, China is finally reopening its economy. Experts say the change could have significant impact on investors across the globe. A boom in economic activity in China will likely spur growth around the world and help ease the supply chain pressures that have been built up since the beginning of the pandemic. On the other hand, the sudden release of all that pent up demand could push inflation higher. That's because stronger demand for goods, services, and raw materials will likely increase prices, especially if supply is limited within China and around the world. In the US, that could mean higher interest rates for longer, since the Federal Reserve has been hiking rates to bring down spiraling consumer prices. Higher interest rates tend to weigh on the price of financial assets like stocks. Finally, looking at next week, we have companies reporting on Monday: Palantir, West Fraser Timber; Tuesday, Coca-Cola, TC Energy, restaurant brands. Wednesday is Cisco, Shopify, Suncor, Manulife, Barrick Gold, and Go Easy. On Thursday, we have Cenovus, Agnico Eagle Mines, Fairfax Financial, Canadian Tire, and EQ Bank. And on Friday, we have Air Canada. Economic events next week. The big one is on Tuesday is the US January inflation report. And on Wednesday, we have Canadian housing starts and US oil inventories. Thursday is US housing starts and jobless claims. And Friday is Canadian Industrial Price Index. That concludes my thoughts for the week. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. And don't forget to check out the Basic Investing and Personal Finance course on CanadianMoneyTalk.ca, or the link is in the description. Please like, subscribe, ring the notification bell, and may you have a profitable day.